In Chapter 2, we're going to get into double entry accounting, and we are going to go through the first 3 steps in the accounting cycle. This lecture is broken into 2 mini lectures, and we're going to start off by looking at double entry accounting. In particular, we're going to look at the T account. This slide lists the learning objectives for this chapter. So in part 1, which is what we're going to do, we're going to look at accounts. We're going to look at debits and credits and how they affect different types of accounts. Once we've gone through that, in part 2 of the lecture, we're going to look at how we record our transactions in the general journal, how we then post the debits and credits from the general journal to the affected ledger or T account. So you will notice in the book that there are ledger accounts that are used for posting, but there are also T accounts. For our purposes, we're going to use the T accounts. Then, once we have come up with the final balances in each T account, we will prepare what is known as a trial balance. So, learning objectives 2, 3, and 4 will be in the second half of the lecture. But first, we're going to look at the T account and debits and credits. Here we have an example of a T account. Obviously, we can see why it's called a T account because of the shape of the account. So as you notice, on the horizontal axis, we're going to put the account name, whether it be cash, accounts receivable, equipment, accounts payable, common stock. Then you notice on the left side there's a debit, on the right side there's a credit. Depending on the type of account we're talking about, a debit could mean an increase or a debit could mean a decrease. Likewise, with the credit, depending once again on the type of account we're talking about, the credit could be an increase or it could be a decrease. So in the double entry accounting system, each transaction must affect 2 or more accounts to keep the accounting equation in balance. So if we go back to our accounting equation, assets must always equal liabilities plus stockholders' equity. So therefore, in order to maintain that equality, debits must always equal credits. Now the double entry accounting system, just as a point of trivia, was developed by an Italian monk, Luca Pacioli. He was a mathematician and a physicist. So it wasn't a business person who came up with this. It was a monk who happened to be a mathematician. Alright, so the debits and credits, as I said before, records a record of increases and decrease in the specific asset, liability, stockholders' equity, revenue, and expense item. And as we'll see later, revenue and expenses do affect stockholders' equity, specifically the retained earnings account. Alright, so here's an example. We don't have an account name here, but the point here is that if the sum of the credit entries are greater than the sum of the debit entries, the account will have a credit balance. And an example of an account that will have a credit balance is the accounts payable. If the sum of debit entries are greater than the sum of the credit entries, then the account will have a debit balance. So an example would be an asset like the cash account. So this is just to reiterate what we've already said. Assets, the debits should equal credits. Liabilities, the credits should exceed the debits. So therefore, actually I just noticed I made a mistake. I said that debits should equal credits for assets. That is not true. That for assets, the debits should exceed the credits. So for assets, as you can see, debits will cause an increase. For liabilities, credits will cause an increase. So that the normal balance of an account is what causes it to increase. So with an asset, we'll say that an asset, equipment, has a debit balance of whatever the amount is. On the liability side, a liability like an accounts payable account has a credit balance of whatever that account balance is. All right, now we look at stockholders' equity. And initially we're looking at stockholders' equity in terms of, actually there are 5 account types. The common stock represents paid-in capital, and paid-in capital is what an investor pays into the corporation in exchange for ownership. So that the normal balance of the common stock account is a credit. So in order to increase the common stock account, we will credit that account. Retained earnings, as we said, represents all the undistributed earnings from prior accounting periods. That also has a credit balance, so if we're going to increase retained earnings, we will credit the account. We have said that dividends are a distribution of earnings. So dividends come out of retained earnings. So therefore, since a debit would decrease retained earnings, then what will increase the dividend account balance is a debit. So as we declare dividends, the dividend account will increase, or will debit that account, but ultimately that has the effect of reducing retained earnings. All right. The other 2 accounts that affect retained earnings are revenues and expenses. So revenues would cause retained earnings to go up, so therefore we would credit a revenue account, and a credit to retained earnings will cause retained earnings to go up. Expenses will do the opposite. It'll cause a decrease in retained earnings of stockholders' equity. To decrease retained earnings, we would debit that account, so therefore it makes sense that the expenses would have a normal debit balance. Now these are things that you need to commit to memory, so that debits and credits and the accounts affected, that stuff must be memorized. So you must know that if you want to increase an asset account, you have to debit the account. If you want to increase liability, you have to credit the account, etc. So this is another reiteration of what we've talked about before. It takes the major categories of accounts and breaks them down. So those accounts that have normal debit balances are assets and expenses. Those that have normal credit balances would be liabilities, equities, and revenues. And in terms of stockholders' equity, we're talking about the common stock account and retained earnings. As we move on in this course, there will be other stockholder equity accounts that we will be adding to the list, but that's much later on. And once again, we have a summary of the debit and credit rules, but this time, look at this. It is presented in terms of the accounting equation. Remember what we said, assets must always equal liabilities plus stockholders' equity. And what we also said was that there are other accounts that affect stockholders' equity, namely retained earnings, and those accounts are revenues and expenses. So we said that revenues will cause retained earnings to go up. So if we're going to increase revenues, we are going to credit the revenue account, which will increase retained earnings. Expenses, to increase expenses, we will debit an expense account, which will have the effect of reducing retained earnings. Right, and then the next slide shows us once again the relationship of equity accounts to the income statement. And then lastly, once again, here is another illustration of the various classifications of accounts and their normal balances. And actually, this particular slide is one of the best summaries of the accounts and their normal balances. So this is something that you will want to refer to. All right, in the next lecture, what we're going to then do is we're going to look at journal entries, posting to T accounts, and also the trial balance. So let us proceed to the next lecture.